Welcome back to Trading Hour. Well, Varun Lohchab from HDFC Securities joins us now to discuss market fundamentals and his top sectoral picks. Welcome, Varun. Thank you so much for joining us. First up, going into Q3, what were expectations, especially from the IT pack? Most of the results have come about. Midcap IT seems to have beat. What is your view as far as the entire IT space is concerned?
So IT space, we are overall, neutral in our model portfolio. I think the current context of domestic slowdown, IT looks like a good place to be in, at least in the first 6 months. But we believe valuations have already run up quite a bit in last 12 months, and therefore the absolute upsides from here on are not going to be, very high if I look at the entire year. So probably sometime during the middle of the year, one should switch back from IT to more domestic cyclicals like banks and consumer, especially on the discretionary side. So that's our overall view. We are, we continue to like some of the, mid-cap ideas and large-cap ideas in IT, but we are selective and slightly more valuation conscious.
Do you want to tell us about your Midcap IT day? Because today is a full Midcap IT day. Even Cyient and Mphasis are seeing buying ahead of their numbers later.
Yeah, so in Midcap IT, our preferred picks, Persistent has been one of our top house picks for quite a few years now, and our analyst is still bullish on that. We have a positive rating on Persistent. Then in terms of Zensar and Mastech are the other two stocks among the mid to small cap IT where we are positive. And among the large caps, TCS is our preferred pick. So that's the overall sort of view on IT.
Understood that. Are you penciling in a strong recovery, especially from US BFSI space?
So BFSI is obviously seeing, improvement across the board. All management commentaries have hinted towards that. But so there is a overall demand improvement expected in FY26, but the extent of improvement is still not more than 2 to 3%. So a 4% dollar growth will go to 6 to 7% at an aggregate level. Now, obviously, company specific is going to be different. So there is an acceleration led by BFSI and bottoming out in other verticals. But the extent of acceleration, we believe, is more or less also captured in the estimates by everyone. So unless there is a surprise on those estimates, the further upsides on stocks may be fairly limited. But in the current context of the market, they are a good place to be in from a relative perspective.
Right. Varun, the other set of stocks or the other sector that we want to discuss is actually the FMCG space. HUL has continued to disappoint investors, but on the other hand, some signs of recovery coming in as far as Pidilite is concerned. Where do you stand in FMCG? Which are your preferred picks and which are the ones that you will continue to avoid?
So again, overall FMCG, we are slightly underweight in our model portfolio. But if you look at, again, we are being very selective out there. There is a slowdown for sure, at least as far as urban FMCG demand goes. And it's a mix of multiple things. One is high inflation, which is impacting the urban mass and the urban poor. And also, typically for a large FMCG incumbent players, there is a quick commerce sort of a negative impact because of fragmentation of demand. So I think on FMCG, we are overall, I would say, mildly negative, with very few stock-specific ideas. Like we continue to like Marico in the FMCG space. Among the mid caps, we like Jyoti Labs in the FMCG space. Large cap, actually, we don't have much upside in either ITC or HUL. So we don't own them much in our model portfolios. So it's more mid cap, Marico, Jyoti, and to an extent Dabur, where we see some upside over a 12-month period. But again, it will take another 1 or 2 quarters for things to stabilize in terms of demand. And then from there on, you should see slightly better growth in second half of this calendar year.
In discretionary demand, actually more than that, if you could just tell us incrementally, where has your view changed in the last 1 or 2 months? Because some of these calls you've been holding on to for a while. Spot some trends for us, some changes that you've made in your thought process.
So, our thought process is that into this weakness, which has been there in the last couple of months and which will probably continue in the first half of this calendar year, we want to buy more on the domestic cyclicals, which is essentially banks and consumer discretionary. So these are the two areas where we have been adding weights through the stock price decline. So banks, again, from a valuation perspective, are starting to look attractive. I think it will again take another 1 or 2 quarters for things to stabilize on the loan growth side and on the credit cost side before you start to see uptake. But they are starting to look attractive from a 12 to 18 month point of view. Similarly, consumer, we believe both will bottom out in first half, but incrementally we are adding more positions in consumer discretionary, things like apparel, QSR, select consumer durables, as we expect second half to be better in this calendar year. And even some of the capex or the infra investment plays, given there has been a decent correction in some of those names as well. We believe again capex will pick up in the next financial year, and therefore we are adding. So we are adding domestic cyclicals in this weakness.
Understood that. Thank you so much, Varun, for joining us. A slightly shorter conversation today, but we'll chat with you once again soon to get your thoughts on the channel once again. Time now for a short break. We'll get you more on the markets on the other side.